Hello, I'm Sesha Sen from the New Indian Express. Welcome to Business Unboxed, where we take the hottest topics from the world of money and break them down for you piece by piece. Indians right now are trapped in a whirlwind of uncertainties, both financial and health, that has thrown their finances far off track. And just like they did after the economic devastation caused by the first COVID wave, borrowers are now again holding onto the funds even at the risk of defaulting. And that's because the spread of infections have continued to inflict pay cuts, job losses, and higher medical expenses. This, we can tell you, is one part of the problem. The other is slow economic recovery and enforcement of payments, as a result of which banks are reeling under a mountain of debt and NPAs. But before we dig deeper into India's bad loan problem, let's first understand what a loan default is and when an account turns bad. Generally, a default occurs when a borrower fails to pay back a debt according to the terms of the initial arrangement. In case of most consumer loans, this means that successive payments like EMIs have been missed over the course of weeks or even months. Such accounts pass through three stages before ultimately slipping into the NPA category. According to the Reserve Bank of India, a loan account can be classified as non-performing only if payments have not been made for a period of 90 days. Now, on the face of it, India's bad debt problem seems to be improving, and that's because banks have been reporting a smaller percentage of bad loans over the last few years. Gross NPAs, for instance, have fallen significantly since FY18. However, it is important to note here that write-offs have accounted for quite a large share of these GNPs, although recoveries from such written-off accounts remained low. Higher provisions for such losses also help banks report lower NPAs. Notably, loans are written off once the bank is convinced that there is no immediate chance of recovery, and while the borrowers of such loans remain liable for repayment, the recovery of such loan is no easy task. So, what does India's bad loan landscape look like right now? Industries still continue to make up the lion's share of bad debt, yes, but there are incipient signs of stress in both retail and MSME loan accounts. For MSMEs, credit flow increased substantially due to disbursement under the ECLGS scheme in FY21. And since this was part of the pandemic relief package, experts worry that there could be a further increase in stress levels once various relief measures come to an end. As for retail loans, which are loans given to individuals, they could soon become the largest segment in India's credit market, taking away the top spot from industrial loans. For instance, as economic distress has increased, personal loans have seen accelerated growth, rising to 12.4% in May 2021 compared to 10.6% a year ago. But borrowers' ability to repay has been affected. For instance, 32 million auto debit transactions worth rupees 26,000 crore have failed, and this is primarily due to insufficient funds. For those unaware, auto debit transactions include recurring payments such as EMIs, utility bills, etc., for which borrowers have already agreed to allow banks to automatically debit the amounts from their accounts. And this auto debit bounce rate or failure rate has been rising steadily since April. That apart, different types of consumer debt like mortgages, credit cards, auto loans, and student loans have all exhibited different patterns of stress during the pandemic, and this stress is already reflecting in bank balance sheets. Its June quarter financial results released so far reveal that all is not well on the asset quality front. India's most valuable lender, HDFC Bank, has seen its gross NPA jump to 1.47% from 1.32% in the previous quarter. While for Bajaj Finance, the bad loan ratio nearly doubled in the same period, and bad loans across all other businesses have risen, auto finance being the worst affected. According to the company, both businesses and debt management was affected due to the strict lockdowns. And these figures would be higher for both the lenders if we take into account the loans written off in the June quarter. While HDFC Bank is known for keeping its asset quality under control, the spike in bad loans on its books only underlines the severity of the problem. Both the Reserve Bank of India and more recently HDFC Bank's CEO Shashidhar Jagdishan have warned of higher retail loan delinquencies in the near term. Now, efforts are on to clean up this accumulated stress in India's banking system. NPAs totaling to around rupees 2 lakh crore are to be sold to the soon-to-be operational bad bank, which is also called the National ARCL. Around 80,000 to 90,000 crore of loans are expected to be offered to the NARCL in the first phase. After this transfer of NPAs is carried out, gross NPA numbers on the books are expected to come down. But until these troubled assets are actually resolved, this would simply be headline management, because the stress would continue to exist in the system. Frankly, nobody really knows how the next couple of months are likely to turn out. But as India braces for the feared third wave, further economic disruption is only likely to make the situation worse. If you like what we do, hit the like button and don't forget to share and subscribe the video. Thank you for watching.